Welcome to Just Go Grind, a show that focuses on helping you launch and grow a business and navigate the ups and downs of entrepreneurship. I'm your host, Justin Gordon, and in this episode, we have Jonny Price, the Director of Fundraising at Wefunder, the largest regulation crowdfunding platform. And I was so excited to bring Jonny on to talk all things crowdfunding and a different option for entrepreneurs who want to raise capital. We talk about in depth what Wefunder does, how they're different from other platforms out there, the benefits of regulation crowdfunding, some of the downsides as well, and really how to get started with crowdfunding, deciding if this is right for you, what that process actually looks like, and some success stories, some examples of companies that have raised a couple $1 million with equity crowdfunding, as well as what this means for investors, really the everyday person who wants to invest in startups and how this changes the game for them. As always, the show notes are at justgogrind.com/podcast, and you can support the show by leaving a rating and review over in Apple Podcasts. And finally, if you're interested in equity crowdfunding for your startup, head over to justgogrind.com/Wefunder. You can get a discount on the Wefunder fees and learn more about this crowdfunding process as well. Without further ado, here is Jonny Price, Director of Fundraising at Wefunder. Jonny, welcome to the show.
Thanks so much, Justin. Good to be here.
Yes, and I'm excited to talk about crowdfunding and Wefunder specifically. For people who aren't familiar with Wefunder, what is Wefunder? What's kind of an overview of the company?
Yeah, Wefunder is an investment crowdfunding platform. Think of it as Kickstarter for investing. We help startup founders raise up to a couple of $1 million in capital from both accredited investors, but also unaccredited investors. And we enable ordinary people as well as millionaires and billionaires to invest in startups they love.
And for people who aren't familiar with accredited investor, what is that exactly, Jonny?
Yeah, accredited investor is a definition that the SEC put out, which basically historically has determined who's able to invest in startups, with only accredited investors being able to invest. And historically, the definition of an accredited investor has been that you have either an annual income of $200,000 or more, or $300,000 household income, or $1 million of assets excluding your house. So it's really kind of basically the wealthiest 5% of the population or so. And those were the only people that got to invest in Google or Uber or Airbnb. And a few years ago, the Jobs Act passed Congress in 2012. Our founders actually helped to get that legislation through Congress. And then Title III of the Jobs Act was called regulation crowdfunding. That's what we do at Wefunder. And that's what enables anyone, unaccredited investors as well as accredited investors, to invest in startups through registered funding portals, of which Wefunder is the biggest.
And with crowdfunding as well, Jonny, for entrepreneurs who are wondering if this is the route for them, I mean, who are the types of people or companies that should consider crowdfunding as an option to raise funding for their company?
Yeah, so firstly, there's a few types of crowdfunding, right? So there's, perks-based crowdfunding, which is what most people think of when they hear crowdfunding. So that's Kickstarter, Indiegogo. That's, basically pre-revenue or a discount on a product or a perk. And so that's a great fit. Obviously, a lot of very early stage entrepreneurs, maybe pre-product launch is a great way to raise. Oculus Rift is an amazing example of that. So their backers on their, I think it was their Kickstarter campaign, enabled them to put out a product. They then later got acquired by Facebook. And there's a case study I saw online of imagine if Oculus Rift had done an equity crowdfunding campaign as opposed to a Kickstarter campaign. Then rather than their, angel and VC investors making a ton of money, the crowd that backed them would all have made a ton of money. So investment crowdfunding as opposed to perks-based crowdfunding is where you're raising investment capital, usually equity. We do some debt as well on Wefunder. But usually equity. So if you're raising from angel investors, or even if you're doing a friends and family round, you can instead do that on Wefunder. And long-winded way of answering your question, but in terms of the companies that are best fit for Wefunder, I mean, broadly speaking, if you're raising 50K to a couple of million, we can help you to do that more easily. But I think the sweet spot is probably B2C. One, because you have an audience of customers that you can then email the campaign to and say, or promote it on social media and say, hey, you love the product. Now you can invest in the company. And secondly, because if you're a B2C company, if you recruit an army of investors, from your customer base or prospective customer base. That's going to be, more loyal customers who spend more money on you versus your competitors who have a super high net promoter score and are brand ambassadors for the company. So I think B2C tends to be the sweet spot, but just over the last few months, we've raised, a couple of $1 million for several B2B startups. So certainly not restricted to the consumer facing sector.
Yeah, it seems like such a huge benefit to have all those backers behind you because, yeah, they're going to be evangelists for your company and help you along the way as you're growing to spread the word, to, use your products, whatever it may be, which is a huge benefit for this type of route. And what I would like to know though is what is the process like for an entrepreneur, using Wefunder from beginning to actually having a campaign up and running a campaign? I want to at least start with what is the process in the beginning?
Yeah, absolutely. So I lead the business development team at Wefunder. So me or someone on my team initially will talk to every company that we launch just to set clear expectations. What are the pros and cons of running an equity crowdfunding campaign on Wefunder, and then just kind of set up the campaign for success. We then connect the founder to an account manager on our team, and they then need to file what's called a Form C with the SEC. This is what legally unlocks a regulation crowdfunding campaign. The process of doing that varies, can be a few days. I think the average is 3 or 4 weeks. So getting together the legal disclosures, financial disclosures, putting the campaign page together, figuring out a fundraising strategy, and then pulling the trigger on the campaign and launching it. Obviously, you want to have tried to get your ducks in a row before you launch so that there's a big bang when you launch the campaign. That then builds momentum early on, and hopefully you close it super quickly. We've had companies raise 7 figures in less than a week on Wefunder, several actually over the last few months, during which time we've seen a lot of growth through COVID. But you can leave a campaign up for longer if it's going more slowly. I think the average fundraise lasts about 3 months. So call it a month of prep time to launch, 3 months to raise the money. That's an average. But obviously, if you have a super hot startup or a huge audience, or you're very creative in terms of hustling and marketing and getting the word out and raising the money, it can go quicker than that.
And you said like the pre-launch thing, a month of that. Like, what are some of the things that companies are typically doing to prepare to really have the best possible launch, I guess they could with WeFunder?
Yeah, so maybe 3 buckets. One is kind of legal financial disclosures, kind of compliance, SEC stuff, just making sure every I is dotted, every T is crossed, set it up right. That includes the terms of the offering. So you're raising on a convertible note, a safe, a price round, what's the valuation, etc. Secondly would be the campaign page. The video, which honestly, especially with Kickstarter and Indiegogo, you see these like super glossy marketing videos. That's all good, especially if you're B2C. Like it's definitely not bad to have an awesome video like that. We're actually recommending that the video you upload is just you talking into an iPhone camera, about the business as the founder. That's ultimately what investors are investing in, is you as the founder and the vision you have. And so that's kind of, makes it relatively easy, but, making the campaign page really jump out to investors, grab their attention, and our team will kind of work with founders on doing that. And then the third bucket is the fundraising plans. So, lining up angel investors to invest on day one to kickstart momentum on the campaign, figuring out your list of who you're going to email, who you're going to call, friends, family, maybe there's a social media push, an email blast to your customer base. So all of the things which, and it's really cool, right? Because before regulation crowdfunding, normally if a startup's raising in Reg D, they can't do any of these things to fundraise. Regulation crowdfunding allows you to, I mentioned you can raise from unaccredited investors as well as accredited investors. You can also publicly promote the offering, right?
Yeah.
So a founder could come on the Just Go Grind podcast and talk to your audience about their company and say, hey, go over to wefunder.com and you can invest in my company. So I think that whole kind of fundraising plan is another one of the things that a founder will want to be working on in the few weeks before launching the campaign.
Yeah, and I've actually had Christine Utram from Everyday. I know she was funded on Wefunder, as well as Ed Vincent from Festival Pass is on there right now as of
Yeah.
October
Are
2020.
you
So
going to
maybe there's
claim
nothing
the
to
credit then for Christine raising 1.3 million? She
what
was
she raised
really
before.
languishing. She was really languishing, and then she came
Yeah.
on the Just Go Grind podcast, and all of a sudden, boom, 1.3 million in her bank account.
Yeah,
Yeah,
in
she's really
seven
awesome.
hours only, actually, too. It only took 7 hours, and she raised the whole thing, and all
There you
right
go.
after Just Go Grind.
New
So I will
record.
take
New record.
100% credit for that. And you had talked about as well, Jonny, just going back for a sec about, you're talking to the founders in the beginning when they kind of just getting started and getting set up about some of the pros, cons. Can you go through maybe a few of those, or talk through that a little bit for founders?
Yeah, absolutely. So I normally highlight three potential concerns or downsides of WeFunder. The first is that you do need to publicly disclose financials. So obviously, every founder that launches with us is fine with that and is comfortable with that. But there are some founders, for whatever reason, that want to keep their financials close to their chest. And so, if you're not comfortable publicly disclosing financials, then that's certainly it's just not a good platform for you. And kind of more broadly, like it is a public way to raise capital, right? So you've got to be kind of you know all in on that and excited about that, as opposed to reticent about that. The second thing is that it takes work, right? So Christine says this. I don't know if she mentioned this on your podcast, but she came on our podcast and she mentioned this. It's hard work to run a WeFunder campaign, or at least it normally is. Like Lost Spirits is a distillery in LA. They raised 2 million from their fans in a week, and really just by sending a couple of emails. So if you have a huge audience, or if you're a really hot startup and you can find an awesome lead investor who's going to promote you to their network, it can actually be pretty easy. But I think most founders, especially if you're raising $1 million, usually it's going to be work. You're running a marketing campaign, you're hustling, you're putting yourself out there, and so I say that just because I like to set realistic expectations. If someone's coming in and just expecting, well, we're just going to launch the campaign on WeFunder and watch the money roll in, I just kind of want to set realistic expectations up front. And then the third thing is a little bit more kind of subtle, I think, but at least historically, I think equity crowdfunding has been looked down on by, for example, like VCs. I think the main reason for that was because you were bringing on 1,000 people to your cap table,
Yeah.
which until earlier this year was the case with WeFunder, and so that was obviously problematic. We made some really important changes to our product and the way we structure investments earlier in 2020. And since then, we can now roll up individual investors to one line on the cap table. So the pragmatic concerns from follow-on investors have pretty much been taken care of. I think there's still maybe some subtle kind of, negative stigma, maybe, where some people say, oh, you had to go to crowdfunding because you couldn't raise from real investors. For me, I think that's just becoming less and less real, and as more and more companies have success raising follow-on financing, as many on WeFunder have, and as there's more and more success stories, I think that's just I think a VC is going to get in trouble with their LPs if they pass on a great company because they did a crowdfunding campaign for one of their earlier rounds. And for me, if you're a confident founder, it's just like, if you're talking to a VC in a Series A meeting, you have a growth curve to support that.
Yeah.
And so if you just if your message is, well, yeah, I raised through crowdfunding because I thought it would do good things for my business to bring on an army of investors. And here's the growth curve. Since I raised on WeFunder, it's up and to the right because, in part because, these investors that I brought on in the WeFunder round have helped to, grow my business. And here I am talking to you. And so it's, I think it's pretty subtle, and I think
Yeah.
becoming less of a thing over time.
Yeah, and Jonny, on the note of investors as well, I mean, I know there needs to be a lead investor in terms of WeFunder going through that. How does that work? What's that process like getting that, Jonny?
Yeah, so lead investor is required now for every Wefunder campaign, and that's someone who is, it's not quite the same level of investment or responsibility as there is in being a lead investor in a Series A, for example. It's someone who invests as minimum of $1,000. Average is working out about 20K. But that lead investor is then going to be featured prominently on the campaign page. They're helping you as the founder to negotiate on the terms. And they're also earning 5% basically carried interest on the whole round. So they're financially incentivized to play this role. And so the idea here is that if you are a founder and you're trying to close this awesome angel investor, then if you can have them be the lead investor on your WeFunder campaign, firstly, the financial compensation piece helps you to close them. And then secondly, they're going to be featured on the campaign page, which is going to boost your credibility and increase conversion rate on any site traffic to the page to invest. And then also, if they can get their network to come in behind them, that's really going to help you to execute and get to your maximum goal. So that's the lead investor role, which is also new. It's kind of related to the one line on the cap table thing that we rolled out earlier this year. And the lead investor is also voting for the shares of the individual investors. So the investors are kind of protected, but the lead investor is the one signature that the founder needs to get in the event of a follow-on financing or corporate action. And just to go back to, because I chatted for about 10 minutes on the downsides of equity crowdfunding and didn't actually say the pros of it, which I probably should, given that's my job.
Probably should.
The two main value props I give of Wefunder, the first we've already touched on, which is kind of recruit an army of champions and brand ambassadors, loyal customers. I wrote a blog post on this actually. If you Google raising capital, recruiting customers, Jonny Price, you'll find it. And it's a data-driven example of how this one company, which was B2C, and they sold exclusively through their own website, so they had pretty rich sales data. They shared that sales data with us, and we were able to, they anonymized it, but then we matched it to WeFunder investor data. And we were able to see that two things. One, they had people that invested in the WeFunder campaign that were not previously customers, who then went on to become customers for the first time and spending tens of thousands of dollars a month with the company. And then also existing customers that they had who invested then went on to spend a lot more over time with the company than customers who were spending a similar amount before the campaign but didn't invest. So kind of basically reducing churn, increasing LTV. So kind of getting more people involved in the business is the first value prop. And then the second one, probably even bigger for most founders, is this is just an easier way to raise capital. And so, whatever you're doing to raise capital from accredited investors, angel investors in a Reg D, you can still do that on WeFunder. You can take them in through the campaign. You can even take them in outside of WeFunder if you want to, for whatever reason. But then you can also, one, raise from unaccredited investors, two, publicly promote the offering, and then three, you get in front of WeFunder's 700,000 strong registered user base, who typically accounts for about 40% of the campaign. So just by the marketing that we do to our investor base, you're going to, maybe you double the amount that you're bringing from your own kind of fundraising, which is a big part of the value proposition. So those, recruiting an army of brand ambassadors and champions, and then making it easier to raise the money and more quick to raise the money are the two big advantages, and why I think more and more founders are going this route.
Yeah, and I know you mentioned earlier on in this interview about debt versus equity. Can you take us through a little bit more on the type of structure people use typically when they're raising with WeFunder? I know there's both those, but there's also some other ones, rev share and otherwise. Well, I want to hear a little bit about that as well.
Yeah, absolutely. Probably about 90% of the capital raised on WeFunder is equity at this point, which is roughly split a third between price rounds, convertible notes, and safes. We went through YC ourselves back in 2013, and we kind of used the YC post-money safe as our standard template, which a founder can use to save some money on legal fees as well. So that's kind of the vast majority. But yeah, being an open platform, we are flexible when it comes to investment contracts. And so some founders, because we do tech startups, right? But we also do bricks
Yeah.
and mortar, like breweries and distilleries and coffee shops. And so, there are a few founders that have done just a straight interest rate loan on Wefunder. And then we have revenue share, as you mentioned, which is kind of, I would say, in the middle between, conventional equity investments, where the investor is looking for that hockey stick, looking for that exit, and kind of, conventional debt investments, which are usually collateralized with a fairly low interest rate. So a revenue share deal might be, the founder borrows 500,000 and says, we're going to pay back 2x that or 3x that to investors. And it's higher risk than a standard loan. It's not collateralized. And so, the investor is taking on a higher risk, and so is compensated with a higher interest rate. But from the founder's perspective, if you're building kind of a tech company, even if you're paying a 3x multiple on a revenue share investment, that's a lot less than if than the multiple on an equity investment. And so for some founders with cash flow, a revenue share structure might be the way to go. And yeah, the cool thing about being an open platform is that we can be very, very flexible to whatever contract is going to work for a founder and the lead investor initially, and then other investors on Wefunder subsequently.
And Jonny, I know we haven't really talked about this yet, but what separates or what's the difference, from Wefunder from other crowdfunding that are also equity crowdfunding? I know you mentioned Kickstarter and Indiegogo as more perks based, but in terms of other platforms out there, what separates Wefunder from other ones?
Yeah, so Wefunder's the largest regulation crowdfunding platform by market share. Start Engine is number two, and then Republic is number three, and then there's a lot of other smaller platforms as well. I think a couple of things. I think that the main one is that the we're trying to build Wefunder to work for the best companies. So everything about how we're structuring the investments, for example, we use a custodian structure that truly allows investors to be rolled up to one line on the cap table. I think the structure that we've used for managing these investments, which facilitates convertible notes and safes, which allows for investors to invest in preferred stock. It's a regular YC safe that converts at the next financing round, as opposed to converting at exit. Like investors have voting rights, albeit proxied through the lead investor. So a lot of the ways that we're structuring the investment through the custodian, and then the lead investor component being another feature of that, which I don't think any of our competitors have that. It's working. It's working for investors, and
Yeah.
it's working for founders. So the whole structure of the model, I think we're gearing towards working for the best YC founders. I think our product is very good as well, both the investor UI, so basically optimizing conversion from site traffic to checkout, and also the tools for founders on the back end, all of the kind of email infrastructure we have, etc. So those are probably the three reasons that I give to differentiate us versus our competitors. I think we're fun, cool people as well. Our founders
I'll
help
agree
to.
with that.
There you go. Our founders helped to write the laws. We've founded Wefunder back in 2012. Have been fighting the good fight for a while. We're a public benefit corporation and a B Corp, so I think we're all in this for the right reasons. Like, we're all pretty mission driven at Wefunder. So genuinely in this to try and just help founders and get more capital flow into founders, and especially underrepresented founders throughout the country.
And taking a step back, how did you join Wefunder in the first place, Jonny?
Yeah, so my background is I grew up in the UK, as you can probably tell from my accent. I started my career in management consulting, did that for 4 years, then went to volunteer at a nonprofit called Kiva, which is does kind of crowdfunded microloans for entrepreneurs around the world. It's based in San Francisco. So volunteered there for a few months, then went back to consulting. But after another year or so in consulting, left to join Kiva full-time in 2011. So I joined Kiva, that founded in 2005. So I joined full-time in 2011 to basically lead a pilot program that was disrupting the Kiva model. So Kiva was usually making loans through these microfinance institutions around the world, and and my team was basically trying to take out that middleman and lend directly to the entrepreneurs. Both in Kenya and the US, we launched, which turned out to be a massive, massive mistake. And so then I ran that team for 7 years, grew it from, basically just me and one other guy, Akash Trivedi. We made 5,000 loans to US entrepreneurs, $25 million, zero interest, very focused on low, moderate income entrepreneurs, a lot of loans to women, a lot of loans to entrepreneurs of color. Very, very proud of what we did there. And then there was a new CEO who came in late 2017, and he wanted to take the program in a different direction. So we parted ways, shall we say? And I can go into more detail on that if you want. But in early 2018, then joined Wefunder as director of business development, and have been here for the last 2.5 years. And we've seen a lot of growth in that time. It's I think COVID has kind of really accelerated that in the last few months. I think founders have maybe found it a little harder to raise capital from angels. Plus, they it's harder to raise kind of in-person meetings with angels, right? So
a little difficult, yeah.
Yeah. I feel like people in Silicon Valley are like relatively germophobic as well. So like it's even more so than maybe in a place like here in Tennessee where I'm based now. But a digital platform then as a way of raising money becomes relatively more attractive. And so we did 2.5 million of investment volume in February, but we're on track to do over 7 million this month. And so we've seen a lot of growth over the last few months. And the SEC are currently looking at lifting the cap on regulation crowdfunding from 1.07 million to 5 million. So if they do that, I think the growth of this sector, regulation crowdfunding, is, it's very, very exciting. And we looked at the UK sector as well, where I'm from. And if you look at equity crowdfunding as a share of like angel investing or VC, it's a lot bigger in the UK. And so if we can get up to a similar market share of what there is in the UK, I think there's going to be a lot of growth for Wefunder over the coming years.
And just again, going back to why did you want to be in this space? I know you were at Kiva, and I'm pretty familiar with them as well. But in terms of the crowdfunding and in terms of like financing startups and founders, like for you personally, why this space?
Yeah, so I think it was kind of a little serendipitous how I got into it. Oliver Wyman had this nonprofit fellowship scheme. I did that. I came to Kiva. I was excited about Kiva more because of the kind of international economic development angle, poverty alleviation angle, rather than the crowdfunding piece. But then kind of over the years, 7 years at Kiva, I kind of just thought a lot about crowdfunding as an idea. And it's kind of interesting to see like the blogs I wrote over those 7 years, the language I used, like the evolution of the thinking. And so now at Wefunder as well. And there's kind of two things which really excite me about crowdfunding, right? Both around kind of democracy. So, the first is on getting more capital flowing to founders and leveling the playing field for founders. So right now, less than 3% of venture capital goes to female-only founder teams versus like 80% to male-only founder teams, which is just so insane to me. And if you look at, by ethnicity as well, 1% of VC going to African-American founders, 77% going to 3 states, California, New York, and Massachusetts. So a big part of what I work at Wefunder to do is, get more capital flowing to women of color in Nashville, where I am, or, Cleveland, or, outside of the coasts. And if the investors look like the founders, because we're kind of busting open this kind of historic regulation where you had to be a millionaire to be an investor in startups, then I think a community-based, democratic, people-based approach to financing startups can hopefully lead to more equitable outcomes, as it does in politics. Right? It's like we have a democracy in politics. We think democracy leads to more kind of equitable outcomes in our political decision making versus an aristocracy or a monarchy. And so crowdfunding is democracy applied to finance, right? And so then the other piece there is on the investor side. So there's a lot of wealth that's being created by investing in startups now, right? Like more and more wealth is being created now pre-IPO versus post-IPO, where it was 2 or 3 decades ago. So if the only people that get to participate in that wealth creation are millionaires and billionaires, then that is another force that is kind of concentrating, wealth in the hands of a very, very elite few, which we've been seeing over the last few decades. So I give the story of Jason Calacanis, who invested, as I understand it, invested 25K in Uber and made 125 million in their IPO. So like a 5,000x return, right? And it's like, what if that $25,000 had been split around 125 middle class Americans investing $200 on
Yeah.
Wefunder, right? Then that would have created like 125 millionaires rather than one existing millionaire now becoming, $125 million more wealthy.
Yeah.
So that's kind of the democracy piece on the investor side, and both the founder side and the investor side I get kind of excited about, and above all, that's kind of why I work for WeFunder and I'm in this crowdfunding world.
And on the investor note as well, I mean, what is the minimum investment typically, or how many investors are investing in these deals from WeFunder?
Yeah, so minimum is $100, average is $1,000. So if a company raises a couple of million on WeFunder, and I say a couple of million, you might have heard me say before, 1.07 million is the current max of regulation crowdfunding per the
Yeah.
SEC. If a company goes past the 1.07 million, we open up a regulation D round on top of the Reg CF round, where they can keep raising from accredited investors. And say the combination of a million in Reg CF and a million in Reg D is how, for example, Immersed raised a couple of million last month, or Grow Guru, which is an ag tech company in San Diego, raised a couple of $1 million last month. But if a company raises $1 million on WeFunder, on average, they're raising that from 1,000 people investing $1,000 each. And on average, that's splitting, in terms of investment volume, roughly 50-50 between accredited investors and unaccredited investors.
And from that as well, then, so I mean, what have been some of the? I'm obviously like talking about like exits, like the Uber IPO and stuff. I mean, it's been around for a number of years already in terms of WeFunder. What are some of the either the best companies that have come out of WeFunder, or even exits that have happened after WeFunder?
Yeah, so one really cool example from the earlier days is Beta Bionics. They raised $1 million on WeFunder to make an artificial pancreas. They just raised a 56 million Series B from Novo Nordisk and other strategic investors. Before the launch of regulation crowdfunding in May 2016, the Jobs Act passed in 2012. Then it was 4 years before the SEC rolled out the regulations in May 2016. So during that time, we were focused on accredited investor crowdfunding, what our founders kind of jokingly refer to as rich people crowdfunding. So during that time, we could roll investors up to one line on the cap table. And so we got into some awesome deals like Zenefits, Checker, Ginkgo Bioworks, and Rappi are four unicorns that WeFunder had on the platform, and WeFunder investors were able to participate in. So none of those have exited yet, but on paper, they're unicorns now. And then when regulation crowdfunding launched in May 2016, we couldn't do the one line in the cap table thing again. And when you're raising from unaccredited investors in smaller amounts, that means it's a real problem from a cap table perspective. And so then I think it was harder for us to get in these really, really high quality deals. But now in 2020, having kind of fixed that, I think that's starting to change again. And so Immersed is a really cool example from earlier this year, VR company that is partnering with Facebook, who raised a couple of $1 million in less than a month. The lead investor in them was Daniel Ha, who was co-founder of Discuss, went through YC back in 2007. So it's really exciting for us to see not just the growth in the quantity of deals with COVID, but also the caliber of founders and startups that we're seeing over the last few months is significantly higher, which is really exciting.
Yeah, just looking at obviously the people I've talked to who have gone through WeFunder and other ones I've just kind of looked at. I mean, it's interesting to see where this is going to go. And kind of on that note as well, one of the last questions I have is just what's next for crowdfunding? What do you see as next, especially if that $5 million cap is changed? Like, what do you see as next in terms of crowdfunding overall, Jonny?
Yeah, so I'd say maybe two things. The first is just continued growth, right? So the SEC, if they lift the cap from 1.07 to 5 million, all of a sudden that becomes a lot more attractive to even more startups. And I think, there's very strong network effects here, right? So on Uber, the more drivers there are, the more passengers, it's a better experience for passengers. The more passengers there are, the better it is for drivers. Exactly the same on Wefunder, right? The better startups we have, that's really exciting for investors. And by the way, the startup founders are also recruiting a lot of investors from their network that might not have heard of Wefunder before. And then the more investors there are, the better it is for founders, because the more investors we can put you in front of and the more money we're going to help you raise from the Wefunder investor base. So there's very strong kind of double-sided, network effects on the marketplace. So I think the growth is going to be very, very exciting over the coming years. And, going back to the kind of the stigma or the prestige point earlier, it's like, the more success stories there are, the more, once we start to see some big exits from crowdfunding, I think that's also going to help to accelerate the growth. So that's one thing. If kind of related as well, I look at the quality of our infrastructure and tools for both founders and investors. Our
Yeah.
product, for example, the seamlessness of our operational processes versus 2 or 3 years ago when I joined, and it's right that like it's all gonna there's so much kind of low hanging fruit, but
Yeah.
that's exciting from a growth perspective. And then the other thing, and this kind of goes back to what I said earlier, is kind of one of the leading differentiators of Wefunder versus our competitors is we just want to keep building a product that works better and better for founders. Our CEO's vision is, it, if we're just like an easier place to get money, right? A quicker kind of easier place for a founder to raise $1 million in a seed round. That's table stakes, right? We want to be, competing with angelless syndicates, like maybe some small VCs, where it's like, okay, well, if you could raise money on Wefunder versus, going the conventional angel route, if you could easily raise money either route, over time, more and more, we want founders to be choosing to go the Wefunder route, for example, because they really buy into this idea of, the power of recruiting an army of brand ambassadors and champions, or because, we're building this network of mentors who, can add value and support founders through their journey. So that's basically just trying to make the product work better and better and be about so much more than just the money is really the vision we have over the coming years. So.
And Jonny, where can people go to learn more about Wefunder and then connect with you as well if they would like to?
Yeah, so I think, were you going to put a link on the Just Go Grind
website?
Yeah,
it's already live. Yeah, Wefunder.
Awesome. So that's probably the best place. Just go to Just Go Grind and you'll see a link on there. And my email, if anyone is still listening and wants to chat to me about Wefunder, I'm Jonny at wefunder.com, JONNY at wefunder.com.
Awesome. And for people wondering, like I said, justgogrind.com/Wefunder if you want to learn more there and hear about the little partnership we have going on here, which is very exciting. And Jonny, thank you so much for taking the time to come on the show today.
Yeah, absolutely, man. It's a really fun conversation.
Thank you for listening to this episode of Just Go Grind. I really appreciate you taking the time to listen. The Weekly Grind, which is my weekly newsletter, comes out every single Friday. You can find it at justgogrind.com/newsletter. This is filled with tips, tools, and strategies for growing your business. If you want to know how to launch a business, how to grow it, how to get it off the ground, find employees, all these different things. There's a few tips, tools, and strategies every single week I deliver right to you. justgogrind.com/newsletter. Check it out. Thank you so much for listening. Talk to you in the next episode.